So what sets the top 1% apart? Most people think it's because they earn more, but actually the difference between people who build serious wealth and those who earn a lot but stay stuck is not in their income, it's in their behaviour. We work with 10,000 clients internationally, and in this video, I'm going to show you the 3 patterns I see again and again in people who end up in the top 1%. The first thing the top 1% do differently is very simple, but unfortunately, it's something a lot of us do not do. They know their numbers. A lot of us know our income, but do we know what we're spending? As the old saying goes, if you do not track it, it's not important to you. And if you aren't tracking your spending, how are you ever going to know if you can get ahead? You cannot build wealth if you do not know what is happening. It is as simple as that. The people who build serious wealth know how much they earn, how much they spend, what they own, what they owe, their savings rate, and all these important facts and figures. An easy place to start is by getting your bank statements and going through it line by line to see where your spending is. Someone once told me, show me your bank statement and I will show you what is important to you, as that is what you'll be spending your money on. To make this super simple for you, we've created a free tracking tool which you can access via the link in the description box below. Once you fill in your income and expenditure, you can see where you have money left, which can be saved, invested, or spent. It also does not stop with a spreadsheet being filled in once. Wealthy people constantly review their numbers and make sure they're up to date. The more frequent you can review them, the better. However, it does need to be sustainable. So reviewing it every day is probably not going to work. It's also important that the review is not so far out that it becomes overwhelming when you actually get to it, as there is so much to process. Ideally, numbers should be reviewed monthly or quarterly, but 100% at least yearly. It doesn't need to be obsessive or emotional, but it does need to be consistent. So make sure you set it up that way. When you look at your numbers regularly, you will start to behave differently. You'll notice lifestyle creep sooner. You'll catch bad habits earlier, and you'll see where you might be wasting money and be able to make better decisions without the guesswork. You cannot manage what you do not measure, and the top 1% measure everything that matters. So that's why tracking is so important. In the next point, we're going to talk all about protection. So pattern 2, they protect themselves from false decisions. Before you think about investing or any of the glamorous or sexy stuff, you need to know all of the hard work you've put into your savings and investments does not go up in smoke because something you did not plan for comes along and hits you in the face. So what do I mean by that? Well, life is not predictable and it has a way of throwing us curveballs, as we all know. That could be from a job loss, a business slowdown, a medical expense, a war, or even a family emergency. If you have no liquidity, you're not just dealing with the problem, you're also dealing with the extra pressure of having to find the money to deal with it. And pressure can, unfortunately, as we know, force you into bad decisions. You take on expensive debt, you sell investments when markets are down, and ultimately you end up derailing your own long-term plans. Most financial damage happens when people are forced into these types of decisions. And the top 1% avoid this by keeping 3 to 6 months of core expenses in cash or near cash. That means money that isn't invested in places where volatility could impact it, and it can be easily accessed if needed. This is not about being overly cautious. So let's imagine there's a storm and your house gets flooded. You'll now need to pay for the damage to the house, of course. So you might need to rip up the damp floors, replace any furniture that's been damaged, and maybe even pay for accommodation while repairs are happening. By having an emergency fund set aside, this creates options for you. It stops you from panicking and making bad decisions. It keeps you calm, and most importantly, it keeps you in control. And it protects the long-term compounding you've been working super hard for, and your investments will hopefully enjoy for many decades going forward. So once we have the right amount of protection in place, we can then move on to the more glamorous things, which is where we get to when we starting to talk about growth and investing. And the key here is the top 1% invest first, not last. They do not invest what is left over. Instead, they ensure that all of their investment accounts are taken care of first. They treat investing like a bill that has to be paid. The moment income's in, a percentage moves automatically into their investments. There's no, I'll do this next month, or even worse, wait until the end of the month and see what's left over. The average person invests when it's comfortable. The top 1% invest before it feels comfortable, and they automate it. Automation removes the emotion. They're not constantly adjusting, they're not trying to time the markets, and they are definitely not chasing trends. The 1% already understand something simple, which is that consistency beats everything else hands down. There is no replacement for being consistent and having discipline. Compounding does the heavy lifting for you. It's the 8th wonder of the world, according to Albert Einstein. But it only works if you don't interrupt it. The biggest difference between someone who starts at 25 and someone who starts at 40 is not intelligence, it's time. So if you were 25 in the year 2000 and invested £100 every single month into a simple S&P 500 index fund, by 2025, you'd have turned 50 and you'd have had invested 30 grand of your own money. Even going through the dot-com crash, the financial crisis and COVID, there would be roughly £80,000 to £85,000, assuming an approximate growth rate of 7.5%. You don't need to pick stocks or to time markets. In fact, my advice would be the complete opposite. You need boring, index-based investments invested into consistently and as much time as you can give yourself. This is compounding, and compounding only works if you do not interrupt it. Time in the market is more powerful than trying to outsmart the market. The top 1% understand this. Investing builds wealth, and lifestyle creep can really undo it very quickly. So let's talk about that next. So pattern 4, they control lifestyle inflation. This is where most high earners will fall down. Income rises, lifestyle rises faster. Bigger house, new car, better holidays, flash a watch than my Apple Watch. We've seen it from people around us before. The danger is, though, that on their own, none of these look reckless. But 1 year later, the lifestyle creep can start to make people feel trapped. These people earn more than ever, but they have less flexibility because they're constantly trying to keep up. This is because costs and treats to ourselves quietly stack up, and they remove the most important thing that any of us have, which, as we all know, is freedom. The top 1% increase their investments before they increase their lifestyle. When they get a raise, they increase the amount they're going to invest first. Lifestyle upgrades are always going to be intentional. They don't happen automatically. Your salary does not increase and automatically you have to go on a more expensive holiday. That's just not how it works. And what so many people do not get is that looking rich and being wealthy are two completely different outcomes. The wealthy optimize for flexibility. Low fixed cost gives you options. Options gives you power. And power gives you that beloved freedom. Pattern 5 is they all play the long game relentlessly. The final pattern is all around long-term thinking. The top 1% thinking decades, not quarters, not headlines, not short-term noise. They do not constantly change investment strategies based on news. They do not rebuild their portfolio every year because of how they feel, and they definitely do not panic when markets fall. They have a plan, they automate it, and most importantly, they stick to it. Most wealth is not lost because someone picked the wrong fund. It is lost because they started, stopped, restarted, panicked, adjusted, and interrupted the compounding which we just talked about. The top 1% do not interrupt a good plan. They understand that wealth is built slowly, and they get volatility is the price of admission. And slowly, done consistently, becomes insanely powerful. So if you want to understand what really puts people in the top 1%, it's this. They know their numbers. They protect themselves from false decisions. They invest automatically and consistently. They control lifestyle inflation. And they think in decades, not months. None of this is flashy. None of it is rocket science. All of it works, though. If you do one thing after watching this, Start by tracking your net worth and calculating 1 month of core expenses. That alone will change how you think about money. And if you want more practical breakdowns like this, please subscribe and like this video. Because wealth is not about luck, it's about behavior. Thanks very much for watching.